Welcome to The Explainer. Today, we're going to tackle one of the most popular tools you'll see on any technical trader's chart, the Relative Strength Index, or RSI. You know, it's that wavy line that usually lives at the bottom of a price chart. But what is it actually telling us? Well, let's break it down. You've heard it a million times. Buy low, sell high. It's the oldest piece of advice in investing, right? But the real question is, how do you actually know what's low? Is this price drop a golden opportunity, or are you just catching a falling knife? That's the fundamental challenge every single trader has to face. And this is exactly where the RSI comes into play. It was literally designed to help answer that question by measuring something called market momentum. But what on earth does that actually mean? Okay, so the best analogy I've heard for the RSI is to think of it like the tachometer in your car. Now, the speedometer, that tells you your current speed. That's kind of like the stock's current price. But the tachometer, that tells you how hard the engine is working, right? It's showing you the momentum. The RSI does pretty much the same thing for a stock, measuring the strength behind its price moves. So if you want the official textbook definition, the RSI is a momentum oscillator. All that really means is it's an indicator that moves or oscillates between 0 and 100. Its one and only job is to measure both the speed and the size of recent price changes. And you know, this isn't some new, trendy indicator that just popped up. It was actually developed way back in 1978 by a guy named J. Wells Wilder Jr. The fact that it's still a standard default tool on basically every trading platform out there today, well, that should tell you just how useful people find it. All right, so we know what it is, but how do we actually use it to make better decisions? Well, the most common way, the place everyone starts, is by looking for two key conditions: overbought and oversold. The classic rule of thumb here is really simple. When that RSI line climbs above 70, the asset is considered overbought. You can think of it like an engine that's been redlining for too long. The buying momentum might be getting exhausted. On the flip side, when the RSI drops below 30, it's considered oversold. It's like a spring that's been compressed too much, suggesting the selling pressure is fading and a bounce might be coming. So if you take anything away from this, remember those two numbers, 70 and 30. They're like warning lights on your dashboard. Now, they don't guarantee the price is about to reverse, but they are absolutely the first critical sign that the market's momentum could be about to shift. But, and this is a huge but, using that 70-30 rule blindly is one of the biggest mistakes that new traders make. To really use the RSI effectively, you have to look at the bigger picture. You have to consider the overall market trend. Seriously, context is everything. An RSI reading of 75 might be a huge sell signal in a market that's just been shopping sideways. But in a market that's in a powerful uptrend, that same reading could just be normal. You've got to adapt your reading to the environment. For instance, in a really strong bull run, the RSI might happily cruise between 40 and 80. A dip to 40 or 50 might actually be your buy signal in that context. And in a strong downtrend, the RSI might never even get close to 70. Those classic 70-30 overbought and oversold signals, they work best when the market is just bouncing around in a range. Okay, let's level up for a second and talk about one of the most powerful signals the RSI can give you. It's called divergence. And this is what happens when the price chart is telling you one thing, but the RSI is telling you the exact opposite. It's often a really early heads up that a trend is losing steam. So here's how that works. Let's say a stock's price drops and makes a new low. But when you look at the RSI, it makes a higher low. That's a bullish divergence. It suggests the sellers are running out of gas. Bearish divergence is the opposite. The price hits a new high, but the RSI makes a lower high. It's a hint that the buyers are getting tired. Spotting these can be a real game changer. All right, here's one more advanced technique for you. It's called a bullish swing rejection. It sounds complicated, but it's really just a specific four-step pattern that traders watch for as a potential sign that a downtrend is ending. Let's walk through it. Okay, here's the checklist. Step 1, the RSI drops below 30 into oversold territory. Simple enough. Step 2, it climbs back up above 30. Step 3, it pulls back a little bit, but, and this is the key part, it does not go back below 30. It holds that level. The fourth and final step is when the RSI breaks above its most recent little peak. That whole four-part sequence is the complete signal. Now, after all of that, we have to talk about maybe the most important part of using any technical tool, and that is knowing its limits. So, when does the RSI give you bad signals? And let's be absolutely crystal clear on this point. The RSI is an indicator. It is not a crystal ball. It is giving you clues and probabilities based on what has happened with momentum in the past. It does not, and it cannot, predict the future with 100% certainty. Okay, its biggest weakness is that in a really, really strong trend, the RSI can stay overbought or oversold for a very long time, giving you one false signal after another. I mean, selling just because the RSI hit 70 in a raging bull market is a fantastic way to miss out on huge gains. That's why it's most reliable in those sideways range-bound markets, and why it should always be used with other tools, not just by itself. So the big takeaway here is this. The Relative Strength Index is a tool for measuring momentum. That's it. It helps you understand the story behind the price action. So instead of asking, what's the market going to do next? Maybe a better question to ask is, what is the momentum telling me right now? Used that way, the RSI can help you find much, much better answers.